So we have that buy side liquidity pool right there. This guy can't stay on track. He's got OCD, ADHD, hyperactivity. But you know me, I'm good old ICT. So I did away with that vertical line so we can focus right on that there. You see that right there? That's the beginning of the session for pre-market session, that 30-minute window between 1:30 p.m. Eastern time to 2 p.m. Eastern time. Okay, just like there's a opening range for 9:30 to 10 o'clock once the opening bell occurs for regular trading hours and indices. For PM session, it's the same thing here. So you have to start there. Okay, now watch. This is important, folks. This is really important. Once you know that, okay, once you know that here, you're going to try to determine from that point on where this little segment of time, what price is going to do. Now, when you're brand new or you're next to no experience, or if you're first time viewers, or if you're just recently curious and you just don't really want to subscribe to what I'm teaching, but you just want to see what the old man's up to, you're not going to understand what I'm saying. Okay, but we have been teaching sessions. We've been teaching very specific macros, very specific times of the day where things generally run to a script. Okay, and what I'm suggesting to you is when this time occurs, in my mind, I'm thinking, how is everything after that moment going to impact these 10 minutes? Okay. Now, again, some of you are going to watch this video and not be aware that I've already took down a monster haul this morning, shorting NASDAQ. It'll be on a video after this one. Okay. But my focus is trying to find out what this little range is going to do in time in deference to whatever price books between 1:30 p.m. Eastern time to 3:50 p.m. Eastern time to 4 p.m. Eastern time. So inside that tiny little 10-minute window. Okay. For a person with very little time, as I mentioned yesterday and other times when I mentioned market on close macro, you can do your entire career with just that small little window of opportunity. Not many want to try to do that, obviously, but it can be done. So when it started at 3 o'clock, okay, so 3 o'clock is the beginning of the final hour of trading, regular trading hours. That's what's shaded here. Okay, this entire shaded area is 3 o'clock p.m. Eastern time to 4 p.m. Eastern time. Notice that buy side liquidity pool is sitting right here, and they rallied up, and it's hanging around in here, just shy of that high. Now, as we get closer and closer to the beginning at 3:50 p.m. Eastern time, it's reasonable to anticipate that this is likely to go up there and knock out buy side. But we've been going up all day. All of Tuesday went straight up. Okay. So when the market's like that, it's generally considered long in the tooth. It's an expression. It means it's been doing something for a long period of time, and it's probably growing tired, and it's reasonable to anticipate some consolidation and, or in this case, a retracement. Okay. So as I was watching this market in here and it drops down, it goes right into this little buy side imbalance, sell side inefficiency at the beginning at 3 p.m. Eastern time. Then it starts to rally up. I'm anticipating it's going to run through these relative equal highs, that high and that high. But how far? How far? ICT, how do you know when a turtle soup's going to run out of steam and go the other direction? Yeah, see that? Juliet, tell your boyfriend this is what the real deal is, okay? The rally takes off and clears this high and clears this high right here. Now, what's so special about this particular high? Why would it stop there? Like, what's the significance for all of the selling pressure to come in? All the selling pressure to come in at that moment. And where did all the buying pressure go? Like it's gone. It's fell out of style. And now selling pressure is in vogue. So what determines that right there at the high for that? Think about it. Like the buying and selling pressure myth. I'm going to smash it. I'm going to curb stomp it today. Okay? It's going to have no more teeth. It can't bite you. You don't have to worry about arguing with people. Okay? That little high right there to the tick. There's science behind that. Okay. We're going to go forward and focus on this low, which is a dealing range low and dealing range high. What makes that so? Well, it's the low that's starting at 130, and this is the highest high of the day. That's pretty simple, isn't it? At this point here at 3 o'clock, those levels are absolutely known right there and right there. It's this low is lower than that one and that one and that one. And there's only one high prior to where we're at here, and it's the daily high intraday. Hasn't booked for the daily high yet, but we're in the last hour trading. So where's it smooth? Here. Where's it jagged? Here. So take out the high, go to buy side, and then because we've been going up all day long, it's going to come off the high of the day and then settle lower than the high. That's the anticipation. So we're going to be looking for a rally up above these highs. I teach that all the time. But again, how far should it go up? Well, we're going to bring in the grid. Okay, so we're measuring and grading the low to the high. See that? Carrying it forward, okay, bringing them all the way across to the entirety of the range input upon which we're going to use for the closing the session. If we are looking at this small little dealing range right here, why am I picking that one? Because it's pulled down into buy side and balance, sell side efficiency. It went down as close as you can get to equilibrium of this high to this low. See that? So it's traded down to a discount as close as you can get to it without breaching the midpoint. And it's respecting the buy side and balance, sell side and efficiency. That's what's happening here. Okay. So when price goes down here like that and leaves this high and this high, I'm going to anticipate the market's going to rally up and clear out that buy side. Then reject and go lower. And that would be the market on close script. Now, right away, I know what you're thinking, but how do you know that? I don't know it until it starts to run to that high. I don't want to short it. I don't want to go long yet. I want to see it go up into this high. Right away, you can see that that measurement on this low to high on the fib, if you add negative 0.5, which is what I've been teaching, it'll print this. You got to drag the fib from low up to high and include that on your setting on your fibs. And what you're going to do is you're going to take the old high that was intraday and you're going to grade that there's two ranges there. You see me do this in the recording that you'll see at the end of this video. You'll actually see me execute. Okay, using this, all this logic, I'm using it. It's not market replay. When these goobers out there say, oh, it's market replay. Listen, it's not market replay. It's not. Okay, like you can prove it's not market replay by simply just looking at the open here and the countdown to close on the price axis. And look at the bottom of the screen. You would see the market replay controls. It's not there, folks. And I'm screenshotting as I go, and then I send it to X. And now we're getting the breakdown so that we understand what I was doing, why, and how it relates to yesterday's logic. It's not a reinvention. It's not twisting and contorting the logic. It's me just carrying the same process. So we want to know what the range is that we have to define in the last portion of the day. And we get that measurement here. And when we do that, we can grade this high pulled up to that level that was just shown here. Okay. That level here. So you're going to anchor the fib to this high, draw it up to that level. Make sure the numbers match, okay? And then you're going to get a midpoint in here. That's what you watch me do in the trade recording. That gives you this level right here. 7,786 even. Well, the high on this candle comes in at astonishing, isn't it? 7,786 even. Now, I didn't have much time because I'm trading with a 1 minute chart. And Once it did this, and I proved that that was a halfway point in the trade, or in the video of the trade, I ended up getting in short right inside this gap, which is a buy side imbalance, sell side efficiency with a small little volume imbalance. So you got to include that. But if we're expecting prices to go down, okay, during these last 10 minutes, again, it's surgical strikes. That's all these market on close things are. Small little surgical strikes. It's not to say, look at me, how smart I am, and then some other guy out there that got lucky and he's holding on to something for a couple hundred handles. We're not comparing that. I'm showing you the precision elements, the timing aspects, the script that it follows, the logic that I taught you years ago about market on close. If you're a charter member behind the paywall, that community that does not exist anymore. Okay, you can't join it. I don't do one-on-one mentorship, so please stop asking me. The market started to pull back down and it got below here. Now, anything between this high and that high, if you're trying to get short, would be a viable entry. You could use this wick here, and anything at the midpoint above, anything there, perfect. Perfect. Now here's where it gets interesting. Here's that fair value gap. And it smashes down through. And look what it does. It closes below it. So what does that mean when it does that? According to ICT's order flow rules, that's visually represented in a candlestick. No gimmicks required. No software program required. No heat maps. No level 2. No special charts. No deep penetration charts. None of that stuff. Okay. All these things here, like that volume imbalance, it violates the low of that and closes. That validates this as, if you're right on your bias, that means you got to know the direction. Otherwise, these things are going to fail in your hands. In the beginning, when you don't know what the bias is consistently, it's going to fail in your hands. It does not mean my concepts fail. It doesn't mean that the logic is inferior. It doesn't mean that they change the algorithm. It just means that you yourself as the operator don't know what you're doing yet. And that's okay. That's normal in the beginning. It takes time to learn this stuff. Okay. Validates it. We open on this candlestick and trade right up into the volume imbalance and fails to touch consequent encroachment of that gap, which is defined by that candlestick's low, that candlestick's close, because there's a volume imbalance. So that right there tells you, is the market bullish or bearish according to the rules that I teach in regards to using candlesticks only? It's bearish. So it supercharged the idea that it took the high out. We're fast approaching getting into the window of 3:50 p.m. Eastern time to 4 p.m. Eastern time. And on this very candle that starts the 3:50 macro, the algorithm starts running. What is it using? Is it using Andrew's pitchforks? Is it using supply and demand? Is it using Wyckoff? Is it using level 2, footprint, volume profile, support and resistance? Whatever it is it doing all those things, or is it doing what I'm telling you it's doing? It starts its run, opens, trades right up the inversion fair value gap. See that? I got entered in on this candlestick when it was inside of this little area. I'll show you in a moment. Just go back to the recording too at the end. You'll see it's there. And you see it in real time. It's not sped up. These goobers out there trying to say, oh, he speeds it up because he's trying to hide something. No, I'm not. I'm just making it so it's palatable on X. Simple. But you're getting the long form of it here. And you guys don't want to watch this stuff. You want to know something real quick by watching a small little 5-minute trainer or less. Give me a TikTok version of this, or you can't teach it. You don't know what you're doing. Man, get out of here. Opens, rallies up into the inversion fair value gap, fails to touch consequent encroachment, breaks lower aggressively. This is all the first minute of the macro at 350. Now, to the left of that, we see a small little pool of liquidity here. So there's sell side there. There's sell side here, relative equal lows. There's sell side here. There's sell side here. And then we have the dealing range low for the PM session start of pre-market. So 1:30 to 2 o'clock, that's the beginning. That's the lowest low of that range from here to the intraday high, which we just popped the top of over here. Okay. So what happens if I would have got stopped out? Say it went higher here. Well, once it broke below this again, then I would use this fair value gap to go short again. That's what I would do. You're not going to avoid imperfection. Imperfection is what you're always going to exist in. Even though you're aiming for perfection, it's, like I said, it's a target. It's not a destination. You'll never arrive at perfection. Price action and its delivery can be perfect. In this case, you see it's perfect. Okay. And what we're looking for is the lowest hanging fruit objective. Now let's go back to this range, high to low. Equilibrium is right here. So to reach for a discount PD array, you can use this sell side, you can use this sell side, you can use this sell side. But before you get to this sell side, look at this. Right in there, it's a beautiful little buy side and balance sell side and efficiency. And if we think it's going to come down and take out these relative equal lows that are all the same price, then this could potentially become what? An inversion fair value gap, which is what we would want to see. Well, when you know it, it starts rolling aggressively down through it. We open at the low, trade up, don't leave a body in the upper half. That's order flow rules, according to me, all visually represented in candlesticks. Then the market breaks down aggressively and trades into this pool of liquidity, this pool of liquidity, and then finally takes the low out right there beautifully. Now, let's go into the science behind it a little bit better than just what I've shown. Minor sell side, taken. Minor sell side, taken. Minor sell side, taken. See that? Remember that range I told you about at the beginning that was measuring the high and the low of the day? If this is going to print as the high and it starts to break down and we get that qualifying run off of the inversion fair value gap, we'll say that you use this, okay? My experience allowed me to know that this is reversing. But if this would have been your entry, that's fine. We're going to go with that. As soon as it starts to break down and takes out that low, you can then assume that that's the high and the lowest low that was formed in the morning session. You would get these levels, upper octant, upper quadrant, those two price levels. If you take your fib and measure that, here we go. We're back to school now, Professor ICT. We're dealing with 16ths, okay? So by having that range high and that range low, according to the daily range, we split that in half, okay? Because this is an octant, and an octant is between a quadrant or a percentile. This is a percentile. This is a octant, which is half of the range between a percentile or the highest of the range down to the upper quadrant. So half of that is a octant. Eighths. Well, what's half of an octant or from an octant to a quadrant? A 16th. So you can see that level here, and it comes in at 7,761.75. The low, 7,761.25. 2 ticks. 2 ticks, baby. 2 ticks.